welcome to the deep dive.
Right.
We've gone through the sources you sent over, and honestly, the signals are just chaotic.
They really are.
It feels like we're getting proof that the economy is cooling off, but at the exact same time, the whole political structure controlling it is showing a kind of fragility I don't think we've seen in decades.
And that tension is exactly why we need to do this. Our mission today is, I think, clarity. We have to sort through these signals that are just completely at odds with each other.
Right.
You have this tempering inflation data right next to a political crisis around the Federal Reserve that is just unprecedented. Then you add in these huge consumer cost barriers, healthcare subsidies vanishing, car payments hitting records, and this massive shift into AI infrastructure.
So our job is to figure out what's noise and what's fundamentally reshaping the landscape for you right now.
Exactly.
Okay, let's get into it. And we have to start where the stakes are highest. That is absolutely the drama engulfing the Federal Reserve.
Yeah?
It is. It's officially under siege.
That might be the understatement of the year. I mean, we have the extraordinary news that the Justice Department has opened a criminal investigation
Into Powell himself.
into Federal Reserve Chair Jerome Powell. The focus, according to the sources, is really twofold. First, this massive $2.5 billion renovation of the central bank's headquarters.
And the second part.
And crucially, whether Powell misled Congress during testimony about that project, about its scope, its costs, all of it.
The optics on this are just unbelievable no matter what they find. And Powell himself isn't staying quiet about it.
No, he's come out swinging. He stated pretty explicitly that he sees this investigation as a direct attempt by the administration to influence monetary policy,
To pressure him.
to cut interest rates right before an election cycle.
And that interpretation seems pretty plausible given the White House's response.
Plausible is one word for it. The president didn't hold back at all, publicly called Powell either incompetent or crooked, and then said, flat out, that jerk will be gone soon. This isn't just political nudging. This is an attempt to delegitimize the head of the central bank with a criminal probe. That's a very rare and very risky move on the world stage.
And this is where it gets really interesting to me. The global reaction. You almost never see this kind of unified front.
You really don't. The sources highlighted that the heads of the European Central Bank, the Bank of England, a whole group of global central bankers issued a joint statement.
And it wasn't just some tepid support, was it?
Not at all. They defended Powell's integrity, but more importantly, they emphasized that central bank independence is a cornerstone of global financial stability. It shows that other countries are looking at this and seeing a systemic risk.
They see the same thing we do. And it's all escalating right now towards the Supreme Court.
That's the next big date on the calendar, January 21st. There's a hearing that everyone is watching. It's about the president's earlier attempt to fire Fed Governor Lisa Cook.
So explain this for us. Why does a case involving Governor Cook have so much impact on Chair Powell's future? I mean, everyone already expects his term as chair to be over in May.
Because it's about control, not just the chair position. Analysts believe that if the White House wins that case,
It sets a precedent.
it sets a huge precedent. It would essentially validate the idea that the president has an easier path to remove a Fed governor for something other than, gross professional misconduct. That would make it much easier to then remove Powell using this DOJ investigation as the reason.
So the stakes are really institutional. Even if he loses the chair, his term as a Board of Governors member runs until 2028. Is that why some analysts are saying he'd stay on as a kind of bulwark?
That's the theory. A governor still gets a vote on monetary policy. So if the Supreme Court upholds the existing rules on independence, he stays on the board, a voting bloc against political pressure. If the White House wins, well, the door is open for a much more politically aligned Fed. It's a foundational fight.
And you can already see this instability priced into the markets. After the news of the probe broke, the dollar index dropped 0.3%. But that wasn't the real story.
No, the real story was in safe havens. Gold is just screaming institutional risk right now. It soared. It hit a new record high above $4,600 an ounce.
Wow.
And that kind of move tells you this isn't about inflation fears. This was catalyzed by the high-stakes risk to Fed policy and all the other geopolitical tensions. When gold moves like that, it means investors are nervous about the stability of the entire system, not just where the economy's headed.
It's just a remarkable split screen. The markets are panicking over institutional risk while the actual economic numbers that just came out are surprisingly calm.
It's a total dichotomy.
Let's decode that December inflation data, because the cooling we saw there was pretty notable.
Yeah, the data gives us, I'd say, some reason for cautious optimism. The headline CPI annual rate came in at 2.7%, exactly matching what everyone expected.
Okay, no surprises there.
But the number that really matters for underlying stability, core CPI, the one that strips out, volatile food and energy, that came in at 2.6% for the year.
And that was the surprise.
That was the surprise. It was zero point 0.1 percentage point below the Dow Jones expectation. That implies the inflationary pressure is definitely easing across the board.
Okay, so that sounds like good news. But when you dig into the monthly numbers, you see the cost of living isn't really going down, it's just climbing slower. Where are people still feeling the squeeze?
Shelter. It's the biggest single piece of the CPI calculation, and it was the biggest monthly driver, up 0.4%. But the really visceral hit, the one you feel every week, was at the grocery store. Food prices jumped a very sticky 0.7% in just 1 month.
So even if gas prices went down a little bit.
Right, gas prices fell 0.5%, but your weekly shopping trip still hit your wallet harder than anything else.
And then there's this weird number in the sources. The recreation index jumped 1.2% in a single month. What's happening there?
That one's a real head-scratcher. That 1.2% is the biggest monthly gain for that index since 1993. It's surprising. It's things like, tickets to sporting events, hobby equipment. It kind of hints that consumers who do have extra cash are spending it big on experiences.
At least there's one bright spot.
A small one. Egg prices tumbled, down a massive 8.2% for the month. So, a little bit of deflationary relief for your breakfast.
So essentials like housing and food are still climbing, even if the core rate is softening. But there's another problem, right? The data itself might be a little distorted.
That's a critical point for you to remember, especially on housing. The government shutdown last fall forced the Bureau of Labor Statistics to use something called carry-forward imputation for housing data in October and November.
Which means what, in simple terms?
It means for a couple of months, they basically just copied and pasted the previous month's housing numbers because they couldn't collect new data.
So they were guessing.
Effectively. And that likely underestimated the true rate of housing inflation. So the sources are warning we should expect a day to catch up probably in April that could make the numbers look a little worse for a bit.
And you can't forget the tariffs. Economists estimate those have pushed up overall inflation by, a little over 0.5 percentage point?
Exactly. That's a direct tax, not market forces. And when you add all that up, the real wage story becomes a major problem. Our sources show that inflation-adjusted wages have been, quote, largely flat since 2020.
Stagnant.
Completely stagnant. The employment cost index is actually down 0.19% since the start of 2020.
Flat wages and sticky prices, that translates directly to anxiety. Consumer confidence just dropped to its lowest level since April.
Right. People are worried about inflation coming back, but also about a softening labor market. The labor market differential, the number of people saying jobs are plentiful versus hard to get, is at its lowest point since February of 2021.
And the hiring numbers back that up.
They do. Non-farm payrolls only went up by 50,000 in December. That makes 2025 the weakest year for job growth since 2003 if you exclude recession years. And the weakness is spreading, with job losses now in construction and retail.
Okay, so if your wages are flat and the job market is shaky, you're incredibly vulnerable to big price tags on things you absolutely need. Let's shift to that now. How are people managing big purchases, starting with cars?
The auto loan data it's just staggering. It shows the lengths people are going to just to have transportation. A record 20.3% of new car buyers are financing loans of $1,000 or more per month.
$1,000.
A month. And the average monthly new car payment hit an all-time high of $772.
That is such a high barrier when incomes aren't keeping up. The average amount financed for a new car is almost $44,000. So how are people doing it? How are they absorbing that cost?
They're buying time. That's really it. They're sacrificing long-term financial health for short-term affordability by stretching out the loan.
Longer terms.
Much longer. Loans of 84 months, that's 7 years, or even longer now, make up more than 20% of all new car purchases. You're just pushing debt further and further into the future, which means you're upside down on that loan for longer than ever.
It's a huge reduction in resilience to any future shock.
Yeah.
And speaking of debt, there's this proposal for a credit card interest rate cap.
Yes, a 1-year 10% cap on credit card interest rates, which, when you see the current average is over 22%, sounds like a massive win for consumers.
But the industry is already signaling a fight. JPMorgan CFO said everything's on the table, hinting at lawsuits. Why would they fight something that seems to help people?
Because of the unintended consequences. Experts are warning that if banks can't charge higher rates for higher-risk borrowers,
They'll just stop lending to them.
exactly, they'll just cut off the credit supply to people with lower scores. And for everyone else, they'll probably hike other fees or slash rewards programs to make up the difference. It could actually lead to a drop in overall spending.
Let's pivot now to what might be the biggest and most immediate cost shock for millions, which is the ACA subsidy fallout.
This one is huge, and it's happening right now. The enhanced federal ACA subsidies expired at the end of 2025, and that's expected to cause the average person's premiums to more than double this year.
We're already seeing the initial impact, and it's pretty sobering.
The initial data shows 1.5 million people dropped their coverage for 2026 just immediately. Health experts are ringing alarm bells, saying up to 4.8 million people in total could become uninsured because of this. The cost is just too high for them now.
There's a really specific political angle to this too, isn't there? The enrollment growth wasn't where people might think it was.
It wasn't. The sources point out that 88% of all the ACA enrollment growth since 2020 happened in states that voted for the current president. So you have a massive number of voters in key areas who are now facing these huge immediate cost increases for their health care. This is going to be a major political issue.
Okay, let's turn to where the money is flowing, seemingly regardless of all this domestic drama. Sector shifts and global markets. Because despite all the pain for consumers, corporate investment in tech is it's in super gear.
It's an infrastructure supercycle. We haven't seen anything like it. If anyone suggests there's a bubble in data centers, Digital Realty's CEO said the exact opposite is true. He says the sector is severely undersupplied. They can't build them fast enough.
And the scale of what's needed is just astronomical.
It really is. JLL forecasts data center capacity will nearly double by 2030. They expect AI workloads to account for half of all that capacity. To get there, you need something like $3 trillion in total investment in just the next 5 years.
That's a foundational build-out.
It's non-discretionary. It has to happen.
And while the West is building the physical infrastructure, the competition on the AI itself is heating up, especially from China.
Yeah, we're seeing Chinese firms really prioritize speed and accessibility. A company called Pixverse, which is backed by Alibaba, just released a real-time interactive AI video tool.
What does that mean, interactive?
It means you can essentially direct the video as it's being made. You can control how it unfolds instantly instead of typing a prompt and waiting.
So their focus isn't just on making it look perfect, it's on making it usable.
Exactly. It seems Chinese teams are leading on generation speed and keeping usage costs low. They're focused on scalable production tools to make AI video cheap and fast for a huge number of users. That's a big competitive advantage.
Shifting gears from digital to physical, there's a remarkable comeback story in aerospace in the sources.
A huge milestone for Boeing. For the first time since 2018, they actually outsold Airbus in net orders. On top of that, they delivered 600 aircraft in 2025, their best year in 7 years. It's a huge sign that the supply chain is finally healing and airlines are buying again.
And the airlines are confirming what's driving those orders. It's not about cheap seats anymore.
No, it's all about high-end travel. Delta's strong forecast for 2026 is based entirely on that. They confirmed that in the last quarter of 2025, premium ticket revenue, so first and business class, actually brought in more money than the entire main cabin.
That's a fundamental shift.
It is, and you can see it in their buying strategy. Delta just committed to ordering 30 Boeing 787 Dreamliners. That shows you airlines are locking up delivery slots for these big wide-body planes for years to come because they believe premium long-haul travel is their main profit engine now.
Okay, finally, let's touch on the global flashpoint that sent oil prices jumping this week, the escalating situation with Iran.
Right. Oil rallied more than 2% after a really sharp policy shift. The president canceled meetings with Iranian officials, tweeted that help is on its way to protesters, and threatened 25% tariffs on any of Iran's trading partners.
And the market's fear all comes down to one place.
The Strait of Hormuz, the single most important oil choke point in the world. Experts warn that any conflict could provoke Iran to try and choke it off.
And that's where, what, a third of all seaborne crude flows through?
About 31%. Now, a full closure is a low probability event, but even the threat is enough to rattle markets. A full closure could spike oil prices by $10 to $20 a barrel, almost overnight. That risk is now baked into every trader's thinking.
Before we wrap up, we should make sure to mention one piece of really clear positive news on the public health front that managed to cut through the noise.
Yes, the FDA update on the GLP-1 weight loss drugs like Wegovy and Zepbound. The FDA reviewed 91 different clinical trials and found no evidence linking these drugs to an increased risk of suicidal thoughts or behavior.
So they're taking the warning off the label.
They've asked drug makers to remove those warnings. That is a massive dose of scientific clarity for a really important new class of drugs that could help millions of people.
So if we pull all of this together, we're in a really strange moment. Economically, we saw some cooling. That core CPI number was a nice surprise. But institutionally, we're seeing profound fragility. A criminal probe into the head of the Fed has the whole world on edge.
It's the ultimate study in contrast. The political world is creating maximum uncertainty. And yet these fundamental long-term consumer demands for better health, for premium travel, for digital infrastructure, they're still driving these massive, stable corporate investments. Sectors like data centers and premium aerospace are in a super cycle, almost completely ignoring the political chaos.
It really makes you wonder where the true cost of risk is being paid. We watch gold hit record highs purely on political uncertainty, when the removal of a warning label by the FDA, a measure of pure scientific clarity, is completely overshadowed by political drama. What does that tell you about the true price of uncertainty in our markets? And how does that influence where you choose to put your energy and your assets? That's definitely something to think about until our next deep dive.